Welcome to the Daily Update. This is Being Prepared Thursday, May 5th, where we'll look at the action in the market today and then see how things look for Friday, May 6th. Oh my goodness, you could take all the positive things from Wednesday, completely reverse them, add a little bit more, and then you have what happened on Thursday. Wow. Everything that we saw positive on Wednesday was given back and then some on Thursday. Before I get going in this, I'm trying to switch things up a little bit with the videos. The middle part where I was doing the technical overview and I had all the color coordination things going, that was taking me so many hours just to update, and then there were so many mistakes in it. I'm going to let that go for right now, but let me know. Did you like that at all? Was it just somebody reading to you, something that you could have looked at yourself? Did you find any benefit from that? Is there a way that I could change it and make it a little bit different than the way it was before? I just didn't see where the time going into that was really benefiting you all that much when it didn't give me all that much insight. We could just look at the charts quickly and get an idea. Now, speaking of the charts, you do have access to the slides by going to spxinvestingblog.com. I upload those, and they're available not only for the ones that I use in the video, but any of them that I look at. I'm uploading them there. They're available just to view. You can download it as a PDF, or you can right-click and do a save as and save any of the charts that are interesting to you. I want you to have access to those. Even if you don't go look at them, at least there's something behind what I'm saying when I refer to something in one of the videos. The slides that are not used in the video that I look at will just be on the blog itself. I'm still trying to figure out a way of turning that into a PDF or some kind of a way of getting that information to you that's not real time consuming. Okay, let's go back and talk about Thursday. At the open, it was a large gap lower right at the open. And some of that was just negative vibes that we got from an economic report that came out that kind of shocked the market. Something that I neglected to mention in Wednesday's video, and I should have done this. I teach this in my classes, and I wanted to bring this up, and about the time I was uploading the video, I went, oh my gosh, I didn't mention that. When we see a huge move up, like what we saw on Wednesday, that's just a reaction to something that's happening. What will typically happen is the markets will gyrate around, they'll react to whatever's going on, and then they'll revert back to the trend that we were in before. Just as an example, back in, I think it was 2015, whenever Brexit happened, the markets had a negative reaction to that. It was caught off guard. When I was telling people about Brexit, they would laugh because that's kind of a slang term for breakfast. A lot of people didn't even know that that was happening, at least in the US. Well, then it happened and it caught the markets off guard. They went negative for a while and then went back to their trend. The same thing in the 2016 election. That caught the markets off guard. The markets gyrated around after that and then went back to their trend. You can even make that case for COVID. We were in an uptrend and then everything crashed and went all crazy, but then we reverted back to that trend. Could that be what happened on Wednesday? There was a reaction. It was a pent-up reaction. It was the sell the rumor, buy the news, shot the market higher. Everybody was happy again. What's kind of interesting is some of my doom and gloom folks didn't even hear from them at all on Wednesday. But man, they were sure sending out the information on Thursday. Woohoo! This is just an emotional reaction. So could it be that we were in a downtrend before this and the market spiked up and now we're definitely back in that downtrend? Now that happened a little quicker than it usually does, but that's just something to throw out there as a thought. We ended up going below the daily pivot immediately and S1 down to 41.97. As the day went on, it just got uglier and uglier. Selling took prices below yesterday's low. That's kind of what I was watching. It's like, can we hold the low? Can we hold the low? Nope, we didn't do that. Then going into the close, we saw some more selling, and we set a new low for the day. There was a little bit of buying right at the close, and if we hadn't had that buying, we would have been down quite a bit more. There was a significant 10 or 15 point jump right at the end with the S&P. I think that's about what it was. I look at things on a percentage basis, so point-wise, I'm not always so sure. We ended up being down 3.56%. That's a really big down day. And volume was above average. And what we're fixated on, the technicals are negative. And the surprising thing is, unless you look at a few of our ultra short-term indicators, we're not oversold. There was enough of a bounce on Wednesday. There was enough strength that took us out of that oversold condition. Even with the drop that we saw on Thursday, we're not back yet. So this may have more room to fall. And I'll go through and point out some of those things as I go through the charts. Inflation and interest rates, that's the fixation right now. That's what the markets are totally going with. We do have the geopolitical concerns. Earnings, those ended up being disappointing for the day. And that gave a real negative tone. All right, so what are some comments that we can make? It was a very negative day after Wednesday's rally and then resumed the prevailing trend. That's what I was talking about. Where we were in a downtrend before, we spiked up, and now are we resuming that downtrend? Just something to think about. Wednesday's gains were very quickly erased. I think they were all gone in the first 45 minutes to hour or so after the market was open. Just boom. Earnings ended up being a disappointment to the markets. All the sectors were negative. Rising interest rates really had a negative impact on stocks. We lost that intermediate term support, and I'll show you that. We're not oversold necessarily at this point. That Staples spike that we've been talking about, it's not looking as wonderful right now. In fact, there are none of our possible positive scenarios that are really looking viable at this point. We're just watching to see if something happens. Heating oil is really rising, and gas continues to spike. That's a real inflation concern. The S&P, yeah, we're even a little bit more into correction territory now. And the 10 to 5 yield curve, it's back to being normal. So we don't have any inverted yield curves, at least the way I look at them. As far as the economic reports, this is kind of what spooked the market. The non-farm business sector labor productivity was down 7.5%. So we're not getting as much out of workers right now. They expected only a 2.8% decline. So productivity is down, but unit labor costs are really up. So people are producing less, but having to be paid more. They were up 11.6%, where we expected it to be up 7.3%. So what this is suggesting is that we're seeing weak economic activity and rising labor costs. And this ultimately could feed into corporate profits. And the markets didn't like that. They were going to go down anyway, but they just used this as justification for doing that. But this was pretty negative. Our trend, it's still negative and weakening. It kind of flattened out right now, but we're still in a trend. The bias is negative with the down day. I've switched our momentum back to negative as well. The year-to-date performance, we're down 9.2% with the Dow, 13% on the S&P. Small caps are down 16.7%, and the Nasdaq is down 21.3%. So that's in a bear market, you could say, just based on the beginning of the year. That's not going from the all-time high. That's just year-to-date. Let's go back and look at the day's session. The major indexes, everything was down. Nasdaq 100, the S&P 100, everything you look at. The Wilshire, a broad-based index, value line, mid-caps, small caps, the trannies, the composite, utilities even, everything got hit. Well, and look at the NASDAQ 100's down over 5% in one day. My goodness. Then some of the other major markets we look at, of course, here's the S&P down 3.56. The Dow was down, venture. Looking at internationally, we have the Euro next. It was down. Germany was down. France was down. It was a down day for pretty much all stock markets. Sentiment, we didn't really jump all that much. We're still at fear. We're not really registering an extreme fear reading right now, and here's the chart for that. The VIX spiked up, but it wasn't as high as it was before, but it did climb. And the VIX of the VIX also saw a real increase. The Ulcer Index continues to go up. That means the fear in the markets is increasing. day by day. Here's a longer term view of that chart. The equity put call ratio, it's still declining, but it's pretty high still. As far as inflation, here's gas, where it's spiking up to 3.66. Heating oil, up over $4 now. The different sectors, everyone was negative, with discretionary doing the worst, tech really having a bad day, communication, the three usual culprits here. The better ones at the bottom, utilities, energy, they were down, but not down as much. Staples were also down. So it was an across-the-board down day. Here's the sectors, with energy doing the best, and then tech, communication, and discretionary underperforming a great deal. Then some of the other blog charts that we have here, this is put out by Bank of America, and it's the probability of a recession in the next 12 months based on the front end of the yield curve, so closer term maturities. And the blue number is what we're really looking at. This is based on what the market is telling us. Optimistic or pessimistic, that's how people feel. Well, people are pretty pessimistic right now, so the yellow line, yeah, we're going to have a recession. People that are optimistic that don't seem to really pay attention to what's going on, they just think everything's going to be good all the time, which there's something to be said for that. But you have to be a realist at the same time. They are more optimistic, but less than the pessimistic folks. The number to pay attention to, in my opinion, is the blue line. They're not necessarily seeing that we're going to go into a recession. Now, we'll have to see. GDP comes out again. It gets revised. Other economic reports come out. A lot of people think we're headed towards a recession. And we did have an inverted yield curve. So we'll just have to see how that goes. Another thing is the buybacks. And what I pay attention to on this chart is the lighter blue. It just shows that there's a step up in buybacks, but it's decreasing slightly. And you'll see that as the market goes up, you'll see more buybacks. As the market goes down, you'll see less buybacks, because this began pretty much at the beginning of 2022, the downward move of the light blue line on the right-hand side. Then this is kind of a real funky looking chart, but all you really have to look at here is we have risk on over on the right. Those are stocks. Those that give you good returns when you're right and not very good returns, if not losses, when you're wrong. That's on the right-hand side. And you see all the little dots there. There's a lot fewer dots than what we see over on the left, where it's more risk off. This is when people are in cash, so they're out of the markets, or they're in bonds, or they're in very safe investments. And it's just showing, according to this whole list over on the left-hand side, that most are favoring a risk-off strategy. Also, we have the ISM manufacturing against the S&P earnings per share, and these two tend to go hand in hand. Well, looking at the S&P, it's been going down. That's the black line. But what about this orange line here? It's also been decreasing. Is that becoming a concern? Because it's ultimately earnings that drive stock prices. Another thing that helps with earnings and profitability of companies is the operating margin. And it's just showing, like back in 2018, we had a tax cut and then prices really went up. They're still suggesting that we are going to see an increase in corporate earnings. When you take them all together, the margins have declined slightly from the last quarter, but they're still quite high. So it just shows that earnings are slowing down a bit, according to this chart. As far as the technical alerts, well, we saw a lot of green or blue after Wednesday. Well, we're back to red a lot on Thursday. So we got this whole Christmas thing going on. A lot of negativity. The S&P dropped below 4,300, then 4,200. It got down close to 4,100. The dollar really roared back. The NASDAQ set another 52-week low. The euro is declining as the dollar is increasing. So a lot of damage continues to be done, but we were already in a pretty damaged environment. Even with the big thrust up, there were some positive things, and it looked like things could be improving. Pretty much all of that was wiped off the table on Thursday. Now, we're looking pretty extreme negative, so does that mean we're getting a little too negative? But we're not oversold even on a short-term basis right now, so there might be more room to go down. Intraday, here's the chart. And this one's kind of a difficult one because we just blasted through some of the levels that usually mean something. We gapped lower right at the open. We gapped below the pivot. We broke down through S1. This happened all really quickly. Each one of these lines is 10 minutes. We got down to yesterday's low really quickly, went a little bit below, a little bit above. Then near the end of the day, saw some more selling. And it would have been a lot worse if that green bar right at the very end, that helped improve things so that we were only down 3.56%. We would have been down a lot more than that had that late day buying not come in. As far as our daily chart, we broke down below the pivot level. We broke down below the intermediate term support. Now we have the long-term support underneath where we're at right now. Can that hold if prices continue to fall? And then you can also see where volume was above average. We're down 13.54% from the all-time high. Then technical overview, and I've really pared this down. I just went to, okay, here's some positive things. Energy is positive. Commodities are positive. Gold is positive. Interest rates are positive. Staples are positive. Okay, we have a lot of negative things, and this list really hasn't changed. The Dow Jones Composite, world indexes, junk bonds, FANG, small caps, Dow, mid caps, NASDAQ 100, NYSE, all stocks, ARK. Man, it got hit. Bitcoin even had a kind of a difficult day. Wilshire, world indexes, corporate bond prices, everything was pretty much down. Then some positives, and these are the positive setups. The Copic curve, not happening. Mass index, not happening. Pring bottom fisher, not happening. The small cap ratio thrust, not happening. The positive backdrop after we have an inverted yield curve has not started to materialize yet. The staples spike that I've been talking about, that looked like it was viable yesterday. Well, now it has a question mark after it, and I'll show you the chart of that. So our trend, we're weakening a bit. We kind of flattened out with the ADX, but we're still negative overall, and we're kind of right on top of the moving average right now. So you could still classify this as a negative trend. The Orun also suggests that we're in a negative trend. The sellers on the top are in control. The buyers are decreasing, even though we saw a little bit of a turn up with our oscillator. Looking at Brett, this is what I'm talking about on a very short-term basis. This has been just like a ping-pong match. We go extreme positive, then extreme negative, then back to extreme positive. Now we're back to extreme negative. It's a real volatile time right now, even though we're overall still in that intermediate to long-term sideways trend. Here we have another one. The rate of change on one day, just ping-ponging all over. Just extreme to the other. Now we're extreme negative. The rate of change based on 10 periods has now gone extreme negative. Rate of change long term, 250 periods. It just slipped over into negative territory. The Fibonacci, well, we were kind of happy that we regained the 50% on Wednesday. Well, we gave that up, and now we actually are down to the 61.8% retracement. Standard deviation, with all this gyrating around, we're kind of settling down as far as that is concerned. The stochastics, they looked really positive short term after Wednesday. Well, now we're back down extreme negative. After Thursday, intermediate term, it's trying to climb, but rolling over a bit. Long term is still trying to come up a bit, but extreme negative. The one oscillator that we look at that was looking kind of positive was slope. Well, it's looking a little sloppy. It's not quite as positive as it was after Wednesday. Our trading systems, the Elder Impulse, back to negative with the S&P, back to negative with the spiders. The SAR, it continues to be positive. Remember, this thing doesn't change all that much. There's a lot of drawdowns using this as some kind of signal system. It's still registering the dots underneath, which are positive. There was no new chart formations on the point and figure chart, but there were 3 new zeros that were drawn that are red. And of course, anytime you see a red zero, that is negative. After we saw some nice, pretty green X's yesterday. Long term, we are below the moving average. The special K continues to decline longer term. Broad market, the diamonds back to negative, the Qs back to negative. Other things that we look at, the dollar was up over 1%. We're at 103.8. Oil settled at 108.26, so it was up less than 0.5%, but still up and still quite high. Diesel continues to just climb. And I brought this up in yesterday's video where I had heard about this, somebody discussing this, and it's like, yeah, this is a real problem for getting things transported, for trains, planes, and automobiles. So this could really have an impact on the supply chain, as well as inflation. Bonds dropping still on a price basis as rates go up. And I just wanted to show this. I'll take this off after today. If we behave with this yield curve, we're back to being positive. It's positive 0.04 now. So all the yield curves that I look at are no longer inverted. We saw a real spike up in yields where the 30 years up over 3%, the 10 years getting up over 3% now. The 5-year, they're just really having some interest rate issues, but the short term, the 3-month, they actually declined a little bit. And then we're just keeping an eye on the Japanese yen. It continues to fall. The euro continues to fall as the dollar shows continued strength. Our scenarios not happening right now. Copit curve not turning up. Mass index, it's getting up to the dotted line, but first it has to go up above the blue line before that signal part 1. Not there yet. Bottom fisher continues to fall. The 2-year yield, it's gone up. So we don't know if we've topped out yet on this. And here's the one that was looking positive. It's a little hard to see on this chart, but we did spike up 1.73% in the ratio. So we're getting back closer to the top. We're back above the moving average now. So that's why I have the question marks here. It's not looking as viable right now. Then we're not getting any help from this either. The small caps, the red line, we need to see that burst up a little bit and see how it's just chopping sideways right now. Not really doing anything. So what's our outlook? The technicals are negative and not necessarily oversold unless you take some of the ultra short-term measurements that I showed you. The markets, they're trendless pretty much overall. We remain in this range that we've been in for 2022. The growth value battle continues. Economic reports, we got the big one coming out. Employment situation report. That will be very telling and could probably have a real impact on prices on Friday. We also have consumer credit coming out. It probably won't be surprising if people went into more debt because they're having to live off of savings or credit cards these days. Geopolitical events, the same ones. Russia, Ukraine, China with the supply chain, inflation, interest rates. That's the biggie right now. Oil, which is still very high but kind of behaving currently. Earnings, which were a disappointment. Will they be a disappointment on Friday? These Fed folks, hopefully they went on vacation for a little while, but if they do an interview or a speech or something, that could really help or hurt the markets. And then we're keeping an eye on Japan with what's happening in their bond markets over there. Our scenarios, we are down right now. Rising interest rates and inflation fears. That's the going story currently. Earnings that come out, Fed speak, those things could have a negative impact. The technicals are negative and we're not oversold. Up, it's really hard to find something. None of our possible positive scenarios are really working out right now. The technicals are negative. Maybe some moving averages, some pivot points might provide support. We've got that long-term support if we end up going lower. We have intraday support and resistance that may help or hurt things. It's really hard to find some positive things right now. Sideways, we're not in this scenario because the ADX is above 20. You could, if you're a little more aggressive, because the ADX fell and it's coming back closer to the moving average, that might suggest that you're not really focused on a trend right now. So what's our conclusion? Not hard to make this one here. The S&P's negative, short term, negative and not oversold. Intermediate term, negative. I'm a realist when it comes to this. I was kind of hoping that things were going to turn around after Wednesday, not because I'm a strictly long investor or trader, it's because the world is a better place when the markets go up. And when they're going down, that creates a lot of additional stress. And people are already going through a lot right now anyway. And to add their retirement, their portfolios, their future, to throw that into the mix just adds a lot more stress that people have to deal with. And then long term, we're also negative right now. So thank you very much. This was probably a shorter video. Let me know what you think of this. Is this okay? I'm recording this a lot earlier than I had been recording things, and I should be able to get this posted pretty quick. So let me know what you think. So have a great day, and I will prepare the next video after Friday's session.